Hello students, welcome to my class. This is Professor Vincent Usayai and this is part 3 of chapter 7 presentation, hopefully part 3 and the last part of chapter 7 presentation, internal control and cash. Now we left off at objective 5 in part 2, and we talked about the overview of bank account as a control device and also bank reconciliation. So let's take a look at the additional bank issues. When you open a checking account, hopefully most of you have a checking account and you're already familiar with some of these issues. The bank will ask you to sign a signature card. Supposedly, the bank use that signature to confirm or to cross-check the signature that you write on checks that you eventually give to payees. So number 2, deposit ticket. That is the ticket that you complete when you deposit some fund. Number 3, check. That is a document that authorizing the bank to pay another party. The bank statement, that is what you receive on a monthly basis. The electronic funds transfer, transferring money electronically, and the last is bank reconciliation. So we are going to talk about bank reconciliation in great detail. So moving along, let's take a look at a sample of a check with the related remittance advice. So it is important for you to take a look at the components of this check on your own. All right. I know most of you are already familiar with some of these issues. Take a look at the top left-hand corner. That is the name of the maker, the owner of the check account, and the address. Then also take a look at the middle, pay to the order of. That is the payee. That is the person that you are paying. You writing the check, you are the maker. Then of course we also have the amount space, and you have to write the amount in words. The amount in words is more important or take precedence over the amount in numbers. Then of course at the bottom of the check here you have the name of the bank and the address. So take a look at the routing number and the account number, so on and so forth. So again, like I said, it is important for you to take a look at the components of a typical check. So moving along, here is the nucleus or the meat of this part, that is bank reconciliation. So when we talk about bank reconciliation, what comes to your mind? Let's take a look at the word reconciliation. Forget about bank and forget about the fact that we are in an accounting class. When we talk about reconciliation, what comes to mind? What comes to my mind when I hear about reconciliation is making two things that are not in agreement to be in agreement. An unrelated example: two friends are quarreling. The third party or the third one will come in and try to help them mend fences so that they can be in agreement. They were previously in disagreement, but they are not in agreement. So when we talk about bank reconciliation, what two things are in disagreement or that are not in agreement that we are trying to make agree? In this case, we are talking about our cash account or our cash record for the company and the cash record that the company is keeping for us. So like we indicated earlier, one of the benefits of having your cash in the bank is the fact that you keep records of your cash. The bank also keeps records of your cash, and you have two records of these important and very valuable assets. Now, at the end of the month, guess what happened? The bottom line or the ending balance of the two records supposed to be the same. However, 99% of the time they are not. and the balance or the ending balance of your record and the bank records are usually not the same for three primary reasons. Number one, you recorded some transactions in your check register or in your record, and the bank, for one reason or the other, has not. And number two, vice versa. And the third reason could be you made a mistake or the bank made a mistake. So one of the benefits of reconciling both records is your mistake or the bank mistake can be detected during the reconciling process. Another important reason for performing the bank reconciliation is it helps us to determine the true cash balance at the end of the month. As we are going to demonstrate in a minute, see, at the end of the month, your cash balance as reflected in your books does not reflect the true cash balance of the company. And the bank balance usually would not reflect the true cash balance. Why? Because of the three reasons I just explained. So therefore, at the end of the month, we reconcile both, and that would not help us to determine the true cash balance of the company. So take a look at some of the reasons that are given here in terms of why the two balances usually will not be in agreement. Deposit in transit are standard. Deposit in transit are the deposit that the company made, but they have not been presented to the bank. Usually, for example, on January 31st, you make a deposit at 3 p.m. You record it in your books as a deposit, but the bank has already sent your bank statement in the morning, and that deposit is not reflected on the bank statement. Outstanding checks. You issue a check to an individual, however, the individual did not present the check to the bank, so that check would not be reflected on the bank statement. Consequently, that would be another reason why the two differences or the two records will be different. Bank collections, bank collects some money on your behalf, the bank recorded it, you have not. Electronic funds transfer, service charges, the bank will just take their fee at the end of the month without you knowing it. So it will be reflected in their record but not yours. Non-sufficient fund is also another reason. So all these several reasons can be summarized in the three primary reasons that we discussed as to why the two balances are usually not in agreement. So it becomes very important that at the end of the month you do the reconciliation for a lot of reasons, primarily the two reasons that I told you about, to determine the true cash balance and also to uncover any mistake on your part or on the bank's part. Before we get into a very complicated example, let us take a look at a very simple example of how we perform bank reconciliation. So take a look at this slide. Take a look, like we said, both parties are supposed to have the same balance, but for the three reasons that we just explained, usually that doesn't happen. So take a look at the first line item. On the first, on the book side, we have a $10,000 deposit, and the bank also have the same $10,000 deposit. We issue check number 101, 3,000. We have it as a minus. The bank also have it as a minus. Check number 102, 2,000. We give a check of 2,000 to a party who recently won the lotto and took off to Florida without even thinking about a $10 million lotto, without even thinking about our $2,000 check. So the party did not present the check to the bank. So the bank is not aware of that particular check. So at the end of the month, take a look at what happened. We made a deposit of 4,000. The bank is not aware of it because we made the deposit on the last day. In the morning of that very day, the bank has already sent our bank statement. Now, at the end of the month, take a look at what the bank did. The bank record $100 service charge. The explanation is not there. $100 service charge. So at the end of the day, if you do the math, in our books, we have $9,000 at the end of the month. The bank has $6,900. Both of us are supposed to be keeping track of the same thing, but our balances are different. Why? Because of the three reasons that we'll talk about eventually. The most important thing I want you to know here is none of these two balances reflect the true cash balance of the company. So that is one of the primary reasons why we have to perform bank reconciliation at the end of the month. So let's take a look at this very simple bank reconciliation on the next slide. So take a look at what happened. We started off with the book balance, the ending balance of the book, which is 9,000. Now, something is missing on this slide. So what is going to happen is we are going to add to the book balance whatever the bank added that we did not add. And we are going to subtract from the book balance whatever the bank subtracted that we did not subtract. On the other hand, look at what happened. The ending bank balance is 6,900, so we are going to add to the bank balance whatever we added in our book that the bank has not added. Now, with the same token, we are going to subtract from the bank whatever we subtracted that they have not subtracted. So, listen, this is not in the textbook. In real life, when you are doing your bank reconciliation, one of the first steps that you have to do is to check out every transaction that you have and that they also have. So, if you, for example, like if you go back to the previous slide, like the $10,000, we have it, the bank have it. So we check it off and check it off on the bank statement because that is not the reason why we have a difference. Take a look at check number 101. 3,000, we have it, the bank also have it, so we check that off. So by the time we check off every transaction that both parties have, what is left, we call those reconciling items. Those are the items that we use to do the bank reconciliation. So moving along, so assuming that we did that, take a look at what happened on the book side. The question is, what did the bank add to their balance that we did not add to our balance? So if you look at this slide carefully, there is nothing here that the bank added to their balance that we did not add to our balance. So when we do the bank reconciliation, so there is no reconciling item that that we need to add to the book. Now, in contrast, let's take a look at the minus side. The bank clearly subtracted $100 in bank service charges in their record, but we have not. So we need to back out the $100 from our balance. So when we do that, our ending balance of 9,000 is now 8,900. Now let's take a look at the bank side. The ending balance of the bank is 6,900. Now let's take a look at the reconciling item. We deposited $4,000 at the end of the month that the bank was not aware of. So consequently, that is a reconciling item. So we need to add that to the bank balance. Now, remember the $2,000 check that we issued to our friend that was not presented? That is a minus on our record, but for the bank, they are not aware of it. So at this point, we need to subtract it from the bank. So if you do the math, take a look at what happened. We now have 8,900, 8,900. Bingo. So it has been reconciled. So our balance said, at the end of the month, our balance, our record said we have $9,000 cash, and the bank said we have $6,900 in cash. But in actuality, none of the two, mathematically, the two are right, but none of the two present our true cash balance. So at the end of the day, the adjusted book and bank balance is $8,900. So moving along, here is the example, another example of the reconciliation process. So it is just talking about the process of doing so. We start with the bank balance at the end of the period. We add deposit in transit. Here is another explanation of what I just went through. So we add deposit in transit. That is the cash that's been collected from customer, which has not yet been deposited. Then we deduct the outstanding checks. We include all uncleared checks even from previous period. Then we adjust for bank error, if any, and we have adjusted the bank balance. Now, part B, we start with the book balance at the end of the period and add bank collection, interest revenue, and EFT receipts. We deduct service charges, NFS check, and EFT payment, and adjust for any book error. Then we come up with adjusted bank balance. So that is basically another way of explaining what I just explained to you. And take a look at Exhibit 7-8. Here is the information that you need, and here's the information that you need, and we can use this to play out the bank reconciliation. How much time do I have left?
It's almost 15 minutes now, but...
Okay. So this is the end of part 3 presentation. We are going to go ahead and wrap up this chapter with another presentation.